We have another very important guest joining us. Wilbur Ross of W.L. Ross and Company joins us on the phone line. Mr. Ross, good evening to you. Thank you very much for staying up for us. What's your sense? Are these markets going to be consoled if the central bankers were to move in some fashion, the Fed talking up by indicating it won't hike, or the PBOC doing a triple R cut?
Well, I don't think the Fed will raise in September. I think because of the uncertainties in China and the uncertainties in Greece with their election there, I'd be very surprised if they did raise in September. I think it's much more likely that they would raise in December than in September. But whenever they raise, I don't think that a quarter of a point is such a big deal, and I don't think, therefore, that that's going to be the big fulcrum. I think what happened here is that when the market in China first cracked, the government overreacted. First they raised the margin requirements, then they cut them, then they issued a whole string of things, banning selling, banning short selling, making insiders buy back shares they had sold, doing all kinds of things. And I think that exacerbated the situation because it communicated that the government was panic-stricken. I frankly think they'd have been better off just to let nature take its course for a little bit longer. But the world is not coming to an end. China surely is slowing down. As I think you've heard me say before, we don't think it's been growing at anything like 7% for quite a little while, because if you look at electricity consumption, look at natural gas consumption, look at automobile production, look at copper consumption, look at aluminum consumption, look at steel consumption, look at cement consumption, look at telecom revenues, look at rail freight, none of those are remotely consistent with 7%. So I think the people who are being shocked now are the ones who somehow didn't understand that there is no 7%, that there's a growth, but it's much, much less than that.
Okay. Mr. Ross, good morning. So as the market, comes to terms with the new reality, which is a slower growing China and, various issues across the globe as well, do you get a sense that equities, at least for the near to medium term, has moved into a bear phase? And what would you advise investors to do now?
Well, if I were an investor, I would set prices at which I was comfortable to make more investments and hope that the stocks on the downtick got there. And if they went then further, I'd add a little more. I think this is much closer to being a time to add than a time to subtract.
Mr. Ross, where is the confidence to buy? If the questions over Chinese growth are so serious, will the current stock market valuations in most markets, from US to China to India, be supportable at current levels?
Well, I think that the prices are certainly not cheap, but they aren't ridiculous. The Chinese market had gotten to be ridiculous. You had shares in Shanghai selling at an average of way over 20 times earnings. And I think that's too much for an economy that is probably only capable of 4 or 5% growth rather than the 7% that it used to be. So I think all you saw in China in the beginning was people recognizing what has been a reality for a while. And then I think that became exacerbated by two factors. At the peak, 15% of the entire market cap in China was on margin accounts, and that's always a dangerous thing. And there were more new brokerage accounts opened in the June period than there had been in the whole year preceding. And two-thirds of those people who opened new accounts didn't even have a high school degree. So what you had was very unsophisticated retail investors piling in, often on margin, and that's always a good formula for disaster. But I think a lot of the margin debt has been taken out now. A lot of those little people who probably never should have been buying probably have been taken out of the market now. And so I think we're much closer to the end of the problem than we are to the beginning.
What would you now do, sir, as a longer-term investor across various equity markets? What would you be buying? What would you be selling? Which markets?
Well, I think most markets have gotten very cheap. I particularly think the Japanese market has gotten very cheap. I'm a believer in Abenomics. I think he is undertaking some fundamental reforms of the economy. It may not sound like much of a big deal, but having outside directors on the boards of a very large percentage of the Nikkei stocks is a huge change. And it's going to lead to much better governance, much more attention to shareholder interest, much less simple accumulation of cash on the balance sheet and doing nothing with it. Further, Japan is statistically pretty cheap. And third, about one-third of the earnings of the Nikkei come from emerging countries, come from India, come from Vietnam, come from Thailand, come from Malaysia. So Japan is also a fairly cheap way to play the Asian emerging markets. And I'm a believer also that the Trans-Pacific Partnership eventually will go through, and that will create some problems for China, but will create a lot of opportunities for companies in markets like the Vietnam, the Malaysia, the Thailand, places of that sort. So I think you're going to see a little bit of a reordering of where the very good growth comes from if the TPP goes through.
But Mr. Ross, although the equity markets may recover from this shock, the fundamental problem has still not gone away, right? I mean, how long can a country keep fueling its market with liquidity and just ignore slower growth? So don't you think that this issue will keep coming back to haunt equities and perhaps cap the upside?
Well, remember, liquidity is not a physical state. Liquidity is a psychological state. There's no less liquidity in a physical sense in any of the markets today than there was a week ago or 2 weeks ago. The difference is the owners of the liquidity have changed their psychology a bit. So I don't think the problem is a lack of liquidity in the physical sense. The problem is that the psychology has changed, and therefore people are not willing to pull the trigger with their liquidity. They've gone into a very risk-off position for the time being.
Okay. Mr. Ross, finally, your thoughts on India. Are you looking at the Indian markets as relatively cheap now? Is it on your buy list at all?
Yes. Well, the Indian markets, I think, are reacting a lot like many of the other markets. To me, the big question in India is whether the new government will actually be able to implement all of the very sound policies that they have in mind. I hope they will be able to. I hope they'll be able to penetrate through the great bureaucracy and really get things going, despite being a very democratic, very coalition-oriented government. So I think India has been underperforming its potential for quite a while. We now have some leadership there that's trying very, very hard to make necessary reforms, and I hope that he will get the public support and the support of the people in the Congress to implement the things, because it's a very, very hard task that he has set out for himself, and yet a very necessary task.
All right, Mr. Ross, we'll leave it at that. Thank you for taking the time out. That's Wilbur Ross saying that this is the time to add to your portfolio and not subtract. We have some more for you. Harsh Agarwal, the research analyst at Deutsche Bank, joins us on the phone line now to make sense of the entire situation overnight and what we can expect in various asset classes. Harsh, it's been a good morning, first of all, from Mumbai. It's been a tumultuous ride that we've seen in the last 24 hours across global markets. What has your reading been of the entire situation, and how do you see things pan out from here?
Hi, good morning. Look, it's been a complete disaster as far as markets are concerned. For me, it's been a dangerous cocktail. A lot of things that could have gone wrong have gone wrong. Whether it's FX, whether it's China equities, whether it's commodities, poor results from corporates, everything has gone wrong. Purely from a technical perspective, looking at, fund flows, talking to a lot of investors around the world, things still seem pretty bad. My view is that in the very near term, you likely have more downside to markets here. But I am hopeful that things will turn around sometime in September. We published a note yesterday at Deutsche Bank just looking for factors that we need to play out in September for markets to turn around. And the three key things from my perspective are, one, we need the Fed to actually not hike rates in September. We have the FOMC on 17th and 18th. The market pricing of the likelihood of Fed hike has gone down to almost 20% now. So let's see and wait and watch that. I do feel that if the Fed does not hike, it would likely, lead to some sort of a relief rally in the EMFX and perhaps support commodities a bit. The second factor from my perspective, which is critical to watch, is some form of support from China. There are already talks about China potentially cutting RRR by 50 basis points potentially this weekend. China this morning did come and inject 150 billion RMB in terms of reverse repo in the market. So we need a more coordinated and bigger support from China. These measures would likely be artificial and may not help in the very long term. But the way Chinese equities are going right now and impacting, sentiments and investor perception of China, we do need the Chinese government to come in with something big and more coordinated to support the equity markets there. The third thing, which is key, is clearly oil. Oil again feels like it's in a bottomless pit right now. We did feel the same back in January, if you recollect, and then suddenly when oil was at 45, 40 back in January, we saw the data from U.S. in terms of inventory buildup and rig count start improving, right? So I'm hoping, again, somehow magically that data again starts improving in September. So look, I think that there's a good chance we see all these three at some point in September. And again, if we do see these three things play out, we'll likely see a bounce back in risk assets, right? I mean, a lot of this kind of, sell-off you've seen has been driven by technicals. I think fundamentally valuations look cheap now, so it's a question of when technicals and sentiments turn around from my perspective.
Okay. Hi, Harsh. Morning. Thanks for joining us. What if China didn't support? It is U.S. markets and U.S. central banks and developed market central banks which normally come with a lollipop when the markets start throwing a tantrum. China may not do that. China may want to give that rate cut when they feel the economy needs it, probably because of deflationary pressures. If the Chinese were to intervene, only by the very mature yuan fixation we have seen, yesterday it was actually an appreciation, and this liquidity infusion, our market's going to take it very badly.
Yeah, look, if China doesn't step in with anything, I think things will get a lot more uglier than what they are right now, right? Because again, in markets like these where things are not driven by fundamentals, but more by technicals and sentiments, if China does not step in, things get worse, right? But also keep in mind that China needs to step in my view, not just to support the markets, but also things on the ground are slow, right? I mean, we know China is slowing quite hard. You could argue the yuan depreciation was basically, to convince the IMF to get CNY in the SDR market, but there's also a school that argues that it was done to basically, support China's exports and help the slowing economy. So again, from my perspective, China needs to support the markets, not just to support equity valuations, but also because I think on the ground things are slow. And, a lot of results which are coming out from Chinese corporates, and we are in the middle of a very heavy reporting season from China, results are bad. And you can actually see it in companies' numbers that demand is very weak on the ground, right? So again, I think China needs to come out and do something to support the broader economy as well.
Okay. The Asian markets many of them are in oversold territory currently. Even if we do see a rebound because of the measures that you alluded to, do you think that the trend for the very near term has changed from a buy on dip to a sell on rally market? And do you think every rebound could perhaps be sold into?
Yeah, look, it's a good question, right? Look, I don't think we'll see a very sustainable rebound. We definitely will not go back to the highs, in any market we've seen this year, I guess, right? So it's a good question. I mean, will accounts sell on rallies? Again, look, I feel the positioning generally is very light across asset classes, right? I mean, there are a lot of shorts out there. So I do feel that if we see a rally, it will likely carry on for a while. Again, we may not go back into the highs we've seen this year, but I think it will be more than sell on rally kind of market from my perspective.
Harsh, would you agree with that view? And since you track, the whole bouquet of the Asian markets, which are the markets that you see that could outperform from here on?
No, look, I focus more on the Asian credit markets. I do agree that, as I said before, valuations do look attractive in my view from a fundamental perspective. So I do agree that, it's time to be adding very selectively in companies and, names you have high conviction on, and it's not time to sell. You can never pick the bottom, as we know, and I think the markets will bounce back at some point. I think it's a question of time from my perspective, right? I think two markets we've been very negative on the credit side in Asia have been Malaysia and Indonesia. We've been underweight both the countries. Again, given political noise in Malaysia, given what's happening with oil price, given the dependency that both markets have on foreign capital, so I think we've kept the underweight on both countries as of now. We are relatively, I would say, more constructive. Again, in the credit space, markets like, Philippines and India. I think China is the big elephant in the room for us. It's a big kind of country for us in the credit space. We've been overweight China. Again, we haven't gotten the call perfectly right on China so far, but again, we're keeping the faith. So, we are overweight, I would say, markets like China, India, and Philippines, and underweight Indonesia and Malaysia at this stage.
All right, Harsh Agarwal, thank you very much for sparing time for us. So that's two views we have from two diametrically different regions of the world, one from the United States and one from Asia as well, one on credit markets and one on equity markets. That's the view really, not a time to subtract. That's the common view that we got from both